Hi, I'm Joy Macknight, Deputy Editor at The Banker, and I'm joined by Mark Smith, Global Head of Liquidity Management Services at Citi, to look at the key trends developing in 2017. Thanks so much for joining us today, Mark. So 2016 was a year of uncertainty and some volatility. What do you think are the key trends that are developing in 2017?
It's certainly a very interesting year that we've just been through. A number of events that happened that were really not part of the consensus or expectations of broad population. And from that perspective, I would say there are certainly a number of themes that are going to continue as a result of that. So I sort of break those themes down into almost three different parts. So one is around regulation and tax changes. Tax is a big one. You've got for our treasurers out there, you've got the BEPS, so the base erosion and profit sharing. You've obviously got significant potential impact from US tax changes coming through as a result of Trump's new administration. So that aspect in terms of the regulation and tax changes, really is one of those continuing themes, whereas this year I think is going to be one of seeing the real impact of that in terms of liquidity changes. Then you've got a second theme that is somewhat a continuation as well, which is one of that risk and uncertainty managing. So you had a year of interest rates moving. You clearly had a year of great volatility in FX rates. So as you think about the sort of political outlook, both here in Europe, you've got a number of elections in mainland Europe, so those things can obviously impact the change in there. So I think bedding down and looking at risk management from that perspective is clearly going to be there as well. And then the third is really around automation and security. Clearly 16 has been a year of wide cybersecurity fears. You've had a number of quite well publicised events taking place within a number of corporations and banks, and from that perspective, I think very much a theme of really bedding down, focusing on the cybersecurity aspects, really embedding that in the culture and organisations of teams and of our client base, and then within that, thinking about how automation and changes within that aspect can really help support that and make that aspect of the security really change the focus from automation and straight through processing of things and reconciliation to really help reinforce the risks around cybersecurity.
Okay, and if we think about liquidity and global liquidity, what do you think will have sort of the biggest impact on global liquidity in 2017?
Sure. Well, I think one of them I've already mentioned to some extent, which is the tax changes. So, there are well publicised numbers that there's 2.5 trillion of unrepatriated profits that are out there from US companies. Now, I certainly don't think any liquidity impact will be that large, but you don't have to get a particularly big percentage of that 2.5 to see any US tax changes, both from a one-off mandatory tax of unrepatriated profits and then the sort of longer term tax rate changes potentially taking place in the US. That certainly, I think, is the thing that stands to me as the most significant impact of liquidity changes. Then you've also got the diverging economies still. So you've got the US. We obviously had a rate hike in December, prospect of 2, maybe 3 more next year. And yet you look at Europe and rates probably on hold throughout this year in negative space. So I think that divergence of interest rates will start to create a difference there as well. So they're the two main themes I think that I think will really start to impact the liquidity changes.
Okay, and you touched a little bit on regulation. Like obviously over the last few years, there's been a barrage of regulation that has been hitting the banks, but also the corporates now as well. Yeah. Do you think we've reached a bit of a tipping point on regulation, or do you think that will be, again, a major theme in 2017?
Yeah, I think the impact of the regulations will be changing slightly. When I look at sort of 14, 15, 16, I think a lot of the regulation changes, in my mind, were impacting banks, whether that's on capital or liquidity. There's still some more to do, and clearly there's been a delay in the Basel sort of agreements that were expected earlier this week. But some of the impacts were hitting banks directly that then obviously had an important secondary impact on then how clients deal with banks. So, what's the value of a deposit? How can I make sure that we can still utilise banks for our broader cash management items. Now, I think those regulations, whilst they will still be there, the impact of those directly on banks will reduce somewhat. But still, you're seeing a number of regulations. The BEPS I talked about, the digestion of the IRC 385 and how that impacts pooling aspects. I think, from a client perspective, from a corporate perspective, I think 2017 is going to be really quite a big year in terms of absorbing those regulation changes and then thinking about how their liquidity structures will change, how their capital management will change. So regulation is absolutely still an impact, but the lens of which I see it may be changing slightly.
And in terms of corporate treasurers, how can they become more effective and more efficient in 2017?
Sure. So Citi likes to sort of break this down really into three broad parts, one of which is efficiencies in terms of insights in what's going on. So that's insights both from a country perspective, tax regulation changes, liquidity changes from that perspective. I think we can help treasurers start to see those, absorb them, think about the next steps of that. And then there's a big one which is very much linked to, right, what do we consider best practice? So it's that advisory aspect of it. So, how do you approach your operations in reconciliations? How do you approach your operations in broad liquidity management? Those different aspects, I think, really involve some strong partnership between clients and banks in order to do it well, to really understand, how those processes work, and then really work together to improve upon that, really move towards best practice, and that can be both in pooling structures and things like that as well, centralisation of treasury units, and that really, I think, helps make treasury organisations more efficient, less time spent on, those aspects that are very manual in their processes. If you automate those a lot more, then it frees up treasurers' times and their teams' times to really focus on managing of those risks, thinking through those tax changes that will come through, and as a result, the construct of their overall treasury organisations. So from that perspective, I think there's more work to be done, and I think really the close partnership with banks really helps clients do that.
That's great. Thank you so much for coming in, Mark.
That's a pleasure. Thank you very much.